Hi guys, welcome back. This is the fourth recording in complex group, recording number 4, and it's the one where I actually do the question Rodney. Now the previous recording for Rodney was to introduce you to your first exam question. It was purely there as an introduction, purely there to get your head around the shock of question 1 in the exam. But here is my copy in front of me. If we turn to the back page, you will see that the requirements indicate 35 marks. That's 35 marks. That is 1 hour. You have 1.8 minutes per mark. Per mark, you have 1.8 minutes. If you multiply up 35 marks, you get an hour. So you've got an hour to do this question. You've got just 1 hour to do this question. Now, having recorded that last tape, the introduction to Rodney, I walked around the back of the camera and took a look at the time for my introduction. That was 51 minutes. Now, really, in the examination, you wouldn't be able to dawdle and look at the daisies in the way that I did in that recording. You've got to be a lot more aggressive. Now, I accept that this is the first time that you've seen an exam question, but as you work your way through this course, I want you to improve your aggression. You've got to be realistic. In the examination, it's going to be a hard question 1. It's going to be a near impossible question 1 to do in the time. But how do you make sure that you can survive this particular question, Rodney? Well, you can see from what we've studied earlier that you have basically three complexities, paragraph 3, paragraph 4 and paragraph 5. Paragraph 3 was not too bad, right? Paragraph 4 was kind of okay. Paragraph 5 was nearly impossible. Now, in the examination, you're going to have your question laid out in a similar way. And you have to be realistic. You have to do the question, but you have to do what is doable within 1 hour. And you've got to be realistic. The chances of you actually being able to do paragraph 5 and everything else within the hour is very remote. If you get bogged down in paragraph 5, if you slow down in paragraph 5, then you're not going to be able to prove what you know in terms of the basics. So how are you going to actually pass, Rodney? Well, first of all, the main thing you're going to be doing is adding across, as you always do when you're doing a consolidation question. The main thing you do is add across, add across, add across. But what else are you going to be doing? Well, you're going to be calculating the basic goodwill, doing the goodwill impairment, looking at the reduction in the value of stock, and looking at the other, extra things that are added into this question. And you're going to try and avoid getting bogged down in anything that is difficult in order to make sure you complete everything that is easy, so that you focus your time and spend only an hour on this question. Okay, I think I've said enough about exam technique, so let's have a look at the question, remind ourselves of the question. Now, what I'm going to do is I'm going to record this video more like the way you would actually do it in the exam, okay? So I'm not going to assume that you've seen the earlier video. We're going to go back to basics and just look at this for the first time and say, oh, okay, here's a question, I wonder how it works, and work our way through it, but against the clock this time, more like you would in the examination. So here we go. Rodney. Requirement. Required, prepare a consolidated statement of financial position of the Rodney Group as at the 30th of November. I have 35 marks and that gives me an hour. The following draft statements of financial position relate to Rodney, a publicly limited company Dell, a public limited company and Trigger, a publicly limited company. When I look at the balance sheet of Rodney, Dell and Trigger, I can see that under the phrase investment in Trigger is a figure of 100 that appears in Dell. That immediately tells me that this is a complex group. So here we go, let's get our group structure. So it's a vertical group, because Del clearly invests in Trigger because it tells me as much on the balance sheet. As I look through the balance sheet, I notice that there is a revaluation reserve in Trigger, but there isn't one in Rodney and Del. Therefore, Rodney and Del must be doing cost accounting for property, plant and equipment, but Trigger's doing revaluation accounting. So we have inconsistency between the parent and one of the subs. Therefore, one of the subs must change back from revaluation accounting back to cost accounting for its property, plant and equipment. Therefore, the tangible non-current assets for Trigger, which are given on the balance sheet at 256, will end up being smaller when we work our way back from revaluation accounting back to cost accounting. But more importantly, we need to work out the relationships between the entities. Just underneath the balance sheet, it says the group's policy is to value the non-controlling interest at fair value. So if we're going to value the NCI at full fair value, then we're going to have full goodwill that results, which frankly is the assumption that we expect the examiner to go for 90% of the time. The following information is relevant to the preparation of the group financial statements. Paragraph 1. Rodney acquired 80% of the ordinary share capital of Del on the 1st December 3 years ago. So that's 80%. When the retained earnings of Del were 100 million on that day, on the date of acquisition, the fair value of the NCI was 154 at acquisition. So we have the fair value of NCI at acquisition. The fair value of the net assets of Del was 710 at that date. We have the fair value of the entire net assets. We work out the book value of the entire net assets, and the difference between the book value of the net assets and the fair value of the net assets is the fair value adjustment. Any fair value adjustment related to inventory. So we know what the fair value adjustment is on. It's on inventory, but we don't know the figure yet. The fair value adjustment related to inventory, and these had been realised by the current year end. Okay. So the fair value adjustment is on stock at acquisition, but the acquisition took place 3 years ago. Therefore, the stock would no longer be on the balance sheet now. If the stock's not on the balance sheet now, then the related FVA won't be on the balance sheet either. There have been no new issues of shares in the group since the current group structure was created. Not surprisingly, there's never an issue post-acquisition. Paragraph 2. Rodney and Del acquired their holdings in Trigger. Rodney and Del acquired their holdings in Trigger. So this is a D group, is it? So we learn now it's a D group. Rodney has holdings in Trigger, as well as Del having holdings in Trigger. Now we need the percentages. Rodney acquired 40%. Okay, so 40% is the direct holding. So 40% is the direct holding. Rodney acquired 40% and Del acquired 25%. That's the indirect holding, but I need to work on the indirect holding to turn it into the actual indirect holding. So let's do the direct ownership. It's equal to 40%, as we can see. What we know is that Del holds 25% of T, but what we need to know is what we hold. And in this story, we are Rodney. So what is the indirect ownership? Well, if Del holds 25% and we hold 80% of Del, then we hold 80% of the 25%. We own 20%, which gives us a combined ownership of 60%, and obviously plenty enough to give us control. And therefore the NCI is the other 40%. So the direct ownership is 40%, the indirect ownership is 20%, and therefore the combined ownership is, as you can see, 60%, giving us an NCI of 40%. Okay. Rodney acquired 40% and Dell acquired 25% of the ordinary share capital of Trigger 2 years ago. The fair value of the non-controlling interest in Trigger was 149 at acquisition. Fine. The retained earnings of Trigger on that date was 50 and those of Dell were 150. Well, who is being bought in paragraph 2? It's Trigger that's being purchased in paragraph 2. Therefore, the figure of 50 is relevant and the figure of 150 is irrelevant. There was no revaluation reserve in the books of Trigger at acquisition. So Trigger wasn't purchased with revaluation accounting, it started doing it more recently. The fair values of the net assets of Trigger at acquisition were not materially different from their carrying values. So there's basically one FVA in the whole group, and that's the FVA on stock in paragraph 1. And that FVA on stock in paragraph 1 is on Dell. There's no FVAs at all in Trigger. Paragraph 3, 4 and 5. In the exam we'll quite quickly realise that there are 3 complications. We only have an hour, we're against the clock, and therefore pretty much straight away we'll see, instantly that paragraph 3 is relatively short, paragraph 4 is very short, paragraph 5 is huge, so we'll just blow a big fat raspberry at paragraph 5 and say, I don't think I'm going to be doing that in the time. Concentrate on paragraph 3, concentrate on paragraph 4, make sure you pass the exam. I mean, after all, your main motivation for doing this is not to get the prize, but to pass and earn more money. Keep your eye on that prize, the money, right? Make sure you focus on completing this part of the examination within the hour. However, paragraph 3. The group operates in the pharmaceutical industry and incurs a significant amount of expenditure on the development of products. These costs were formally written off to the income statement as incurred, but then reinstated when related costs were brought into commercial use. The reinstated costs are shown as development inventory. The costs do not meet the development criteria in IAS 38 for the classification as intangibles, and it is unlikely that the net cash flows from these products will be in excess of the development costs. In the current year, Dell has included 20 million of these costs in inventory. So what has Dell done? What Dell has done is written off this 20 and then brought it back from the dead. Slapped it onto the balance sheet. That's clearly wrong. So we're going to adjust for the mistake made by Dell. Oh, who made the mistake? Dell. So having a look on the balance sheet at the line for inventory, we can see that the middle figure is 135. It's that figure that's overstated by 20. Next paragraph. Paragraph 4. Dell had purchased a significant amount of new production equipment early in the year. The cost before trade discount of this equipment was 50 million. The trade discount of 6 million was taken to the income statement. Depreciation is charged on a straight line basis over a 6-year period. Now this one's much harder to read because the examiner has told you the error in the income statement. If you were doing the income statement, you would correct the error in the income statement. If this was real life, you would correct the income statement. But look at the question. It says the consolidated statement of financial position, the balance sheet. So you don't really care what the mistake is on the income statement. What you care about is the mistake on the balance sheet. So what is the mistake on the balance sheet? Well, if the cost before trade discount was 50 and the trade discount was 6, then we must have paid 44. If you pay 44 for something, then you recognise 44 for the thing that you paid 44 for. But we didn't, we recognised 50. So we overvalued tangible fixed assets by 6. So the error on the balance sheet at acquisition is the overvaluation of tangible fixed assets by 6 at the beginning of the year. But that's the error at the beginning of the year. But we don't want the error at the beginning of the year, we want to answer the question. The question says the consolidated statement of financial position at the year end. So the error at the beginning of the year was 6, but the error is on tangibles and they are depreciating. So the error is depreciating over 6 years. So of the original error of 6, 1 has gone to the income statement. But we don't care about the income statement. What we care about is what's the error on the balance sheet. It's an overstatement of 5 at the year end. So where is the overstatement? I don't know. Who's made the mistake? Looking at the story, it says again, it's Dell that's made the mistake. So when we go to the balance sheet, we see the figure for tangibles of 505. Now, rather cutely, you can see that if 505 is overstated by 5, the correct figure should be 500. So Dell, tangible fixed assets, should be 500, and we're going to adjust it by 5. And then you have the very tricky paragraph 5 for the removal of the revaluation accounting. Paragraph 5. The policy of the group is now to state tangible non-current assets at depreciated historical cost. The group changed from revaluation model to the cost model under IAS 16 at the current year's start and restated all of its tangible non-current assets to historical cost in that year, except for the tangible non-current assets of Trigger. These had been revalued by the directors of Trigger on the first day of the current year. So on the very day that the group goes from revaluation accounting to historical cost accounting, we down in Trigger, or they down in Trigger, go from cost accounting to the revaluation accounting. And what we've got to do is we've got to get Trigger to go back to its cost accounting. Okay. The policy of the group is now to state tangible non-current assets at depreciated historical cost. The group changed from the revaluation model to the cost model under IAS 16 at the current year start and restated all of its tangible non-current assets to historical cost in that year, except for the tangible non-current assets of Trigger. These have been revalued by the directors of Trigger on the first day of the current year. The values were incorporated into the financial records, creating a revaluation reserve of 70 in Trigger at the start of the year. The tangible non-current assets of Trigger were originally purchased on the 1st December, 2 years before the current year end. That's 2 years before the current year end. Now, 2 years before the current year end is 1 year before the revaluation. So we have the assets for a whole year, right? We have the assets for the whole year, then we revalue them, and now, a year later, we still have them. All right? The tangible non-current assets of Trigger were originally purchased on the 1st of December, 2 years before the current year end, at a cost of 300. The assets are depreciated over 6 years on a straight line basis. The group does not make an annual transfer from the revaluation reserves to the retained earnings in respect of excess depreciation charged on the revalued tangible non-current assets. There were no additions or disposals of the tangibles for the non-current assets of Trigger for the year end, for the 2 years to the current year. So no change in tangible fixed assets apart from the revaluation. Now there's 2 mistakes in paragraph 5. First of all, fairly obviously, Trigger is doing revaluation accounting and it shouldn't be. But more subtly, Trigger is actually doing revaluation accounting wrong. Now, can you see the retained earnings in Trigger are 60? Well, actually, to be honest with you, that retained earnings of 60 is depressed. You know that revaluation increases the value of assets on the balance sheet, right? So revaluation pushes up the value of assets on the balance sheet. So what it does is it also pushes up the depreciation. Now, in order to compensate for this, there is an effectively compulsory transfer that must be made every year after revaluation. And the transfer is called realisation on use. So some of the 70 should have been transferred into the 60, and that was the first mistake. They got their revaluation accounting wrong. But how much of the 70 should be transferred into the 60? Well, realisation over apologise, realisation on use is over the period of use. Now, the entire period of use is actually 6 years, but what we want is the period of use since the revaluation. Now, just work it out. If we stand at the now, and the asset was bought 2 years ago, but the asset was revalued 1 year ago, then going to the point of revaluation, 1 year had gone. So from this point, when the 70 came onto the balance sheet, how many years remained? Okay, do that again. So standing at the year end, the asset is 2 years old, but the revaluation is 1 year ago. So going back to the point of revaluation, 1 year had gone. So at the point of revaluation, if 1 year had gone, how many remained? 5. So what they should have done, what is effectively compulsory, is a transfer from the 70 to the 60 of 1/5 of that 70. And that compulsory transfer is 5 into 70 gives 14. So 14 should be transferred this year. And if we stayed with revaluation, 14 would be transferred the next year and the next year and the next year. Okay? So the first mistake they made is they failed to do the transfer. So let's just do the transfer in our head. Okay. So of the 70, 14 goes down into the 60. Of the revaluation reserve of 70, 14 comes out and goes down into the retained earnings of 60, pushing the 60 up from 60 by 14 to 74. But how much of the revaluation reserve is left? 56. Then you pick up what's left of the 56 and you smash it against the tangible fixed assets at the top of the balance sheet. Now, knocking 56 against the 256 pushes the 256 down to 200. Then, if you're a real prize winner, you double check that the 200 makes sense. Well, the figure that we want at the top of the balance sheet is the figure we would have had if we hadn't messed with revaluation accounting at all. So, what would we have if we'd had cost accounting consistently? Well, I don't know. How much did the assets cost? They cost 300. How many years ago? 2 years ago. Over a life of what? 6. So what should have been the depreciation charge in the first year? 50. What should have been the depreciation charge this year? 50. 50 plus 50 is 100. Knock 100 off 300, you're left with 200. So that's the figure that we have at the top of the balance sheet. If you take 56 against that 256, it pushes it down to the figure of 200, and you'll have the right figure at the top. Now, be honest, what's the chances of you working that all out in the exam when you're sitting there, your desk is wobbling, there's a fluorescent light that's shaking above you, there's, an invigilator with squeaky shoes going, walking up and down the aisles? There's no chance, is there? So just mug the examiner for whatever you think you can do quickly, and then move on. Don't get stuck down in that paragraph 5. Don't get stuck in it in the exam, but don't get stuck in it now. Because the chances of that repeating itself is very remote. But the chances of paragraph 6 coming up is very high. So let's have a look at paragraph 6. The goodwill resultant from the Dell acquisition was impairment tested at the first and second year after acquisition. Dell's been possessed for 3 years, you see. The goodwill resultant from the Dell acquisition was impairment tested at the first and second year end after acquisition, and again at the current year end. The first and second impairment reviews revealed no problems. However, the current review identified recoverable value of 809 for Dell. So we have an impairment in Dell goodwill at the current year end. And don't forget, Dell is the middle entity. By the way, there has been no impairment in Trigger since acquisition. So there's one impairment, it's in Dell, and it's in the current year. Okay, here we go. So, we do our net assets. Of Dell. and trigger at acquisition and at year end, at acquisition and at year end. Share capital doesn't change. Nominal share capital doesn't change. 500 and 200. Premium share capital doesn't change. $100 in one entity and $50 in the other. Revaluation reserve. There wasn't one at acquisition, and there won't be one at the year end once we've removed it. So retained earnings. As given in the question, it's 200 now in the middle entity and 60 before adjustment now in the lower entity. At acquisition, paragraph 1 tells us that the retained earnings were 100. At acquisition, paragraph 2 tells us that the profits were also 50. Can you see it in the middle of paragraph 2? Profits of trigger at acquisition from paragraph 2 is 50. Okay. What else is going on? Well, there's a fair value adjustment on inventory, on stock. And that's given to us in that's also in paragraph 1. Then there's the complexities of paragraph 3, paragraph 4, and the ridiculously difficult paragraph 5. But paragraph 1 tells us that the fair value of the entire entity, the middle entity at acquisition, is 710. This is interesting. So how does that work? We'll have a look at these figures here. It's difficult for me to get them all on the board at the same time. Have I achieved that? I've just about done it there, haven't I? Having a look at these figures right at the top, first of all. These three figures, the 500, the 100 and the 100 combined, those three figures are called the book value. This bottom figure, the 710, is clearly called the fair value. You know it's called the fair value because it says. And what's the difference between the book value and the fair value? The difference between the book value and the fair value is the fair value adjustment. And the fair value adjustment as a figure is 10. Normally represented by beta for balancing figure. But what is the fair value adjustment on? Well, the fair value adjustment is on, according to paragraph 1, inventory. And not surprisingly, the inventory, although it was in stock at the acquisition point 3 years ago, it's no longer in stock at the year end. So the FVA goes off the balance sheet as well. There are no other FVAs in the entire group. Paragraph 3. Tricky one. There's the error of the reinstatement of the development expenditure. And it was an error. Do you remember it was an error by Dell? You have to look at the last line to confirm that. There was an overstatement of stock of 20. Paragraph 4. That was the one about the discount, or more to the point, the overvaluation of the tangibles. The original overvaluation of the tangibles was 6, but the thing about tangibles is they depreciate. So if you overvalue them, if you make a mistake on tangibles, if you have an error on tangibles, that error is itself depreciating. So the amount of error that's left at the year end is 5. And this is how you present the workings to the examiner. No further workings than this. And then finally, paragraph 5. Paragraph 5, you might remember, is to do with trigger. And that's the transfer on realisation. The transfer for the excess depreciation. Now this figure here of 60 is the retained earnings that we do have. But it's been depressed by the fact that depreciation has been bigger. And what we need is a transfer, and they haven't done it, so they must do it. The transfer is a transfer of the 70 revaluation reserve, and you must take some of the 70 and transfer it each year. You can see that the revaluation reserve is 70 at the year end, and it was also 70 at the year start, so you can definitely tell they haven't done the transfer. But how much should they transfer? Well, they should divide by an appropriate life. Now, the original life of the machines was 6 years, but we don't want the original life. We want the life that it remains at the point of revaluation. The point of revaluation was at the start of the year. And by the time we got to the start of the year, 1 year had gone, and therefore only 5 years remained. So the 70 should have been divided by 5, and 14 should have been transferred into the retained earnings. It wasn't done, so we're doing it now. Then, adding down, we've got 500, 600, 800, minus 25 is 775. We've got 300, and we've got 324. So we have the net assets at acquisition and at year end for both entities, the middle one and the lower one. But what we really want is the balance sheet, is the statement of financial position. And the really good marks on the statement of financial position is the goodwill. As you know from my previous recordings, I'm quite fond of trying to do these next to each other. I do confess it's a bit of a squeeze, but it seems to work and it helps you to speed up, right? So the fair value of consideration is compared to the fair value of NCI and the fair value of net assets at acquisition to give you the goodwill at acquisition. Like I say, I like to have my percentages there and a working. And then that'll give me the figure for the mid-entity D. Oh, I like my percentages and a working. And that'll give me the figures for the lower entity T. Now I do confess that by putting in the working there, we're preparing for the potential for a working. Sometimes you need it, sometimes you don't. But I like to have it there. It gives me space to play with the numbers. It also helps me to get around these percentages as well. I like them. So the fair value of consideration we can see for the investment in Dell was a figure of 640. But what percentage did that 640 buy? Well, that 640, as we know, bought 80%. And that tells us that the NCI is 20%. Not that we do much with that figure for the 20%, because actually to find out the fair value of the 20%, we look at what the examiner says in paragraph 1. He says 154. So 154 is the value of the NCI. 640 is the value of our bit. So the value of their bit plus the value of our bit gives the value of the whole business as 794. But what's the value of the net assets at acquisition? 710. So what's the difference? Well, it's the goodwill, right? So 710 from 794 is 84. So the goodwill is 84 at acquisition. Now it's very tempting to rule off just there, but don't forget there's an impairment. So we'll come back to that once we've got the other goodwill. Oh, wait a second. The other goodwill has two components. You can see that the fair value of consideration is 160 in the first instance. But hang on, that's the 40% direct ownership. That's the direct. What about the 20% indirect? Well, I don't know. What does it say on the balance sheet? It says that Dell spent 100 million. Spent 100 million. Well, every time that Dell spends $1, we spend 80 cents, because that is our ownership of the mid-entity. So we multiply by 80%, not 8%, 80%. We multiply by 80% to find out how much we paid when they paid. So the figure comes out at, ooh, cute, 80. Now in this question, this is the examiner's original figures. You'll notice that these figures, they do actually make sense. Don't expect that they necessarily will in the exam. Can I show you what I mean? Look, 40% is valued at 160 and 20% is valued at 80. That kind of does make sense, doesn't it? But don't expect that it necessarily will in the exam. So if we have an indirect 20 plus a direct 40, we have a combined 60. So the NCI must be 40%. Now the actual percentage is interesting, but it doesn't really help us to get the figure, because actually to get the figure, we get it from paragraph 2 by copying. The figure for the NCI was 149. Can you see it there? So you copy the 149 from paragraph 2 and you copy the 154 from paragraph 1. Back onto the right-hand side to do the T goodwill. What's the fair value of net assets at acquisition? Well, you can see from the working above that that's 300. So our goodwill is the difference. And I'm feeling a bit of a scaredy cat. All of a sudden I want to use my trusty Casio. I like jabbing my finger at these keys. Makes me happy, even if I'm rubbish with a calculator, which I am. Do you get 89? I get 89. Now I've confidently ruled off under that fella, and that's because the goodwill at acquisition is unimpaired at both the first and the second year end, so the 89 will be appearing on the balance sheet. It's not so for the other one though. The D goodwill is going to be subject to an impairment. Now, because we've practiced that wonderful question, terror, we feel confident with our impairment. We know how to do this fella. Well, how do we do the impairment? Well, the trick is to compare the carrying value of the entity with the recoverable value of the entity. In order to generate the impairment as a balance, we compare the recoverable value with the carrying value. Here it is. The recoverable value is given as 809 in paragraph 6, if I remember correctly. Paragraph 6. And the carrying value is literal. Well, what two things do you carry as regards the mid-sub? Well, you carry the goodwill. And of course you carry the net assets. But now the question arises as to when the impairment test is happening, when the impairment review is happening. Well, of course, like all impairment reviews, it's happening at the year end. So what is the goodwill at the year end, before impairment? Well, it's this figure that we just had on the board there. It's that figure of 84. What is the net assets before impairment? It's this figure up here of 775. I think I'll use a bit of colour. 775. So 775 is the fella that goes in there. 775. So 84 plus 775 gives us 859. It's rather cute, isn't it? So the balance is 50. And I'll use that symbol again of beta. I'm rather fond of that. So that is the impairment of the entity, but more specifically, it's the impairment of the goodwill. Come on, here we go. So we slot that up there. 50. Now 50 off 84, surely I don't need to do a working to get 34 there. So the goodwill is 34. And I'm about to slap that on the balance sheet. But before I do so, I'd like to remind you, the impairment of 50 is allocated on the basis of ownership. We're talking about the mid-sub now, and the mid-sub is 80% owned by us and 20% owned by the NCI. And therefore that 50 is going to hit us to the tune of 40 and hit them to the tune of 10. Okay? Right. So on to the statement of financial position. You'll probably need a fresh new brand new page here, right? I don't, because my pages are so long. It's rather cute. So the group statement of financial position. We're doing an exam question now, so please resist the temptation to write down NCA. Go for the full name, which is non-current assets. Starting with goodwill. The mid-sub's got 34 left, and the other sub has 89 left. One, two, three. And then we've got tangible non-current assets, properly called property, plant and equipment. It's up to you how you want to present this. I'm going to go for a little double liner here. I'm going to go 1, 2, 3, 0. We have absolute control of the whole lot. 505, we have absolute control of the whole lot. And 256, we have absolute control of the whole lot. But those latter two need adjustment to the tune of -5 because of the error in paragraph 4. There's a 4 written. There we go. -5 because of the... Do you remember the error with the overvaluation of tangibles because of the discount? That's paragraph 4, right? And then 56, we've got to strip out the 56 because of that horrendous working backwards to cost accounting from revaluation in paragraph 5. So actually the figures of 505 and 256 should be simply 500 and 200, giving us 700 and therefore 1930. Current assets. The examiner says, would you like to do some copying? And we say, yes please, I love a bit of copying. Now, markers have started to notice that the better students actually just simply write down the single figure. So rather than writing down these three figures and then adding across, the better students seem to just add across. Now, certainly you do not need to show these workings. If you think you're reasonably reliable with your calculator, then just go for it. The truth is I'm rubbish with my calculator. So if I were a student, I realise of course I'm not, but if I was a student I really would write it out like that. But it has to be said that the faster you work, the more marks you're going to score, and therefore I do accept that perhaps, you know, in this millennium, maybe you should be simply just whacking down the figure. But if you do whack down the figure, make sure you remember there's a bit of minus 20 there because of the error on the development given in paragraph 3. I've decided to float it in mid-air, as you can see, but you can put it anywhere you like in your workings. So adding across, we've got 500, haven't we? So that's 480. Oh, I don't fancy that one. 240 plus 105 plus 49 equals 394. There's no need to show a working. You can just whack straight to the 394. I seem to be conditioned to do the copying, but it must be said perhaps it is more efficient just to simply whack down the number and then away you go. Okay, so there's the current assets. I guess we should be, in the exam, don't bother to add down. Now clearly I'm on my own here, there's no one here to check my workings as I'm working through. So I want to make sure that I'm presenting the right thing to video, so I'm going to add down. So I'm going to add down in just a second, but before I do so I'm going to warn you, do not add down in the exam. There are no marks, there are never ever any marks for the balancing figure on a balance sheet. So leave it blank. If it doesn't balance, it doesn't matter. If it does balance, you don't get any extra marks. So don't do it. I have to do it though because of what I just said. Like I say, I'm on my own here, so I don't know whether I've made any mistakes until I see 3147 at the bottom of the balance sheet. I'm going to keep my fingers crossed. Okay, current assets is followed by equity. Share capital and share premium. Those of the parent. Then retained earnings and non-controlling interest. It's very tempting to write NCI, isn't it? But this is a real balance sheet for a real answer, so we should be writing it in full. Write it in full, sure, but don't work it out yet. There's got to be probably a half mark for the non-current liabilities and a half mark for the current liabilities. Shall I be a good boy and just add across without showing a working? Should do really, shouldn't I? Should get into that. So what we got? 135 plus 25 plus 20 is 180. I can feel myself getting nervous about this because I'm terrible with calculators. 100 plus 70 plus 50, 220. But they do say that fortune favours the brave, so I guess I should go for it. So avoiding showing workings, I've whacked out the non-current liabilities and the current liabilities. They're probably worth half a mark each, but they may in fact only be worth half a mark between them. But they're probably worth half a mark each. Back to the retained earnings and the NCI. As I've said in previous recordings, the NCI is normally the easier of the two. I'm not sure it is in this case, but it's normally the easier of the two, and therefore most naturally it'd be the one you'd be doing next. We're going to do roll forward as we always do, using the examiner's new technique. So we've got two entities, D and T, and we're going to roll them forward. I'll just remind myself that it's 20% for D and 40% for T. Yeah, that sounds right. Now, it's quite a tricky fella, this, because there's quite a lot going on. First of all, we need the acquisition figure, and we'll roll it forward with a bit of growth. But we've also got to, do you remember do this? You've got to strip out the sub-sub. So you've got to strip out the investment in the sub-sub. And if you're not too sure about that one, go and look at the previous recordings, especially Hendricks and what was the other one called? D. Especially D and Hendricks. Watch out for stripping out the investment. But most importantly, the main thing is, of course, the growth. But going back to that wonderful question, terror, we've also got to have a little bit of impairment. So it's pretty full on, this. Anyway, so the acquisition figure for the two fellas was a figure of, I'm not even going to guess, I better have a look, 154 for one, and I seem to remember 149 for the other. 149 for the other, yeah. Now, we've got to strip the investment out of the 154. The trouble with D is not only is D a sub, it's also a parent. So to prevent the double counting of the subsidiary, I do apologise, to prevent the double counting of the sub-subsidiary, we've got to do this stripping out exercise. The thing is about del is it includes 100. So the thing is about the 154 is it includes the NCI of the 100, which is 20%. Actually, the pure D NCI at acquisition is 134. Okay, the pure D NCI at acquisition is actually 154 minus 20. Now the growth, I'll get both figures if I can at the same time. Now, I never do this, do I? I can never seem to be able to cope. I won't even pretend. 710, 775, let's copy that. A lot of numbers flicking past your eyes there, right? 775 minus 710. What a squeeze, isn't it? And what was the other one? Was it 300 and 324? There it is, 300 and 324. Plus 324 minus 300. And the NCI ownership in that is the NCI percentage, of course, which is 20% in one and 40% in the other. And then we got the impairment. The impairment itself is 50, but the amount of that belonging to the NCI is, of course, 20%. What a squeeze that is. I'll see if I can give you a bit more space for that so you can actually read it. That is tough, isn't it? There's no impairment in T, no impairment in T, and therefore no NCI effect of the impairment in T, because there's no impairment in T. Right, okay, how does this work out? So we've got 20 here, we've got 65 multiplied by 20% gives us 6.5 times by 2 is 13, and we've got minus 10 there, haven't we? So it's 154 minus 20 for the double counting, plus 13 for the growth, minus 10 for the impairment of goodwill. So we've got a figure of 137 on the roll forward method. The other one's not quite so complicated, but not such a nice number. The growth is 24, and the NCI ownership in T's growth is 40%. So 0.4 times 24, 9.6, plus 149 equals 158.6. Now, I have to be honest with you, the examiner, generally speaking, goes for brutal rounding, so I'm going to take that. Oh, do double check. If he says round to the nearest 0.1, then you have to round to the nearest 0.1. Does he say that in his requirement? Nope, he's silent, in which case we can round any way we like. So I'm going to round a bit more brutally. 158.6 becomes 159. Plus 137 gives 296. So 296 is the NCI, I hope, if I've got it right. We'll soon find out, right? 296. Where's that? There's the NCI. 296. Now the retained earnings. So the retained earnings is the parent plus the mid sub D and the sub T. The parent profits are 625 at the year end. At first glance. But of course the parent is going to feel some of the impairment. 80% of the 50 impairment will go against us in the parent. The other 20% went against the NCI, right? I'll just put imp above that so we can see that that's the impairment from paragraph 6. Paragraph 6, there's a 6. Right, okay, so that's 50. No, why 50? Oh, yeah. Times by 0.8 gives 40. 625 minus 40. 625 minus 40 equals 585. I'm almost embarrassed using a calculator for that, but I think I will. And then you've got D. So D is growth 775 minus 710. And T, 324 minus 300. 80% belongs to us, the D, and 60% belongs to us, the T. So 65 times by 0.8 is 52, and 24 times by 0.6 is 14, giving a bit of brutal rounding. Got enough space to add down? So 14 plus 52 plus 585, keep your fingers crossed, 651. So there's my 651 for the retained earnings. Fingers crossed, let's go up onto the face. 651 plus 1800 plus 296 plus 400, I guess, is 3147, 3147, 3147. Let's have a look at the other fella. 3147, there you go, it balances. Now, I'm looking into a camera now, and I can see a little flashing light. It's just started flashing. That tells me that the hour is up. Now, how about that for a challenge? Now, granted, okay, I scored 35 out of 35, but that's a lot of work to do in an hour. You have to go fast. So please, when you're practicing this question, try and avoid being obsessive about paragraph 5 and make sure you're okay with the rest of the question. Try to avoid being obsessive about paragraph 4 and make sure you're okay with the rest of the question, all right? Once you're really good with the rest of the question, then have a look at paragraphs 4 and 5 and go into greater detail. Now, if you want to go into greater detail on this, as I mentioned in the last recording, there's a load of detail in the answers in the back. Well done, guys. Complex groups is finished.